In the 1970s, economists faced a nightmare scenario that wasn't supposed to exist. Inflation was skyrocketing. Gas prices doubled. Food prices soared. The cost of everything was exploding. But at the same time, the economy was stagnant. Unemployment was rising. Growth was flat or negative. Factories were closing. This wasn't supposed to be possible. Economic theory said you get either inflation or stagnation, not both. Inflation happens when the economy is hot, when demand exceeds supply, when too much money chases too few goods. Stagnation happens when the economy is cold, when demand is weak, when people aren't spending. You can't have both at once. It's like being simultaneously on fire and frozen, but there it was. Inflation plus stagnation. They called it stagflation, and it broke all the rules. The Federal Reserve tried traditional solutions. They raised interest rates to fight inflation, but that made unemployment worse. They lowered rates to fight unemployment, but that made inflation worse. They were trapped. Every move made one problem worse. For over a decade, the 1970s into the early 1980s, the economy was stuck in this nightmare. And here's what should terrify you. The conditions that created 1970s stagflation are appearing again. Right now, inflation has been elevated. Growth is slowing. The tools that used to work don't work anymore. And we're moving toward a scenario where the empire can't grow but prices still soar. In the next 10 minutes I'm going to show you exactly what stagflation is, why it's one of the most dangerous economic conditions possible, how it destroyed the 1970s economy, and why the conditions for its return are being built right now. Because stagflation is what happens when empires exhaust their ability to grow but refuse to stop inflating the currency. And understanding this pattern is critical to seeing what's coming. Let's start with the basic economics, because stagflation defies conventional wisdom. Normally, inflation and unemployment have an inverse relationship. This is called the Phillips Curve. When unemployment is low, inflation tends to be high. The economy is hot. Everyone has jobs. People are spending. Demand is strong. Prices rise. When unemployment is high, inflation tends to be low. The economy is cold. People are out of work. The spending is weak. Demand is low. Prices stay flat or fall. Central banks use this relationship to manage the economy. Too much inflation. Raise interest rates. Cool the economy. Unemployment goes up a bit, but inflation comes down. Too much unemployment. Lower interest rates. Heat the economy. Inflation goes up a bit, but unemployment comes down. This was the playbook. It worked for decades, until it didn't. In the 1970s, both inflation and unemployment rose simultaneously. The Phillips curve broke. Economists were baffled. How could you have high inflation and high unemployment at the same time? High prices and economic stagnation. It violated everything they thought they knew. But it was happening. Let's look at the numbers. In 1965, inflation was 1.6% and unemployment was 4.5%. No more by 1975. Inflation was 9.1% and unemployment was 8.5%. Both high. In 1980, inflation hit 13.5% and unemployment was 7.1%. This was stagflation. And it persisted for over a decade. So what caused it? The answer is complex, but it comes down to a few key factors. First, the oil shocks. In 1973, OPEC imposed an oil embargo on countries supporting Israel in the Yom Kippur War. Oil prices quadrupled. Then in 1979, the Iranian Revolution disrupted oil supply. Prices spiked again. Oil was the lifeblood of modern economies. When oil gets expensive, everything gets expensive. Transportation costs rise. Manufacturing costs rise. Heating costs rise. The cost increases flow through the entire economy. This creates inflation. But expensive oil also reduces economic activity. Businesses can't afford to produce as much. Consumers can't afford to buy as much. The economy slows. You get inflation from rising costs and stagnation from reduced activity. This is supply-side inflation. It's different from demand-side inflation. With demand inflation, people have too much money and bid up prices. The solution is to reduce money supply and cool demand. But with supply inflation, the problem is rising costs. Cooling demand doesn't help. You just get stagnation without solving the inflation. This is the stagflation trap. Second, monetary policy mistakes. Throughout the 1960s, the The Federal Reserve kept interest rates low to fund the Vietnam War and President Johnson's Great Society programs. This created too much money in the system. At first, it seemed fine. The economy grew, but the excess money was building inflation pressure. When the oil shocks hit, that pressure exploded into high inflation. The Fed initially kept rates too low, thinking the inflation was temporary. By the time they realized it wasn't, inflation was entrenched. Then they raised rates aggressively under Fed Chair Paul Volcker in the early 1980s. This finally broke inflation, but it caused a severe recession. Unemployment hit almost 11%. The cure was painful, but it worked eventually. Third, structural economic changes. The US economy was losing competitiveness. Manufacturing was moving overseas. Productivity growth was slowing. The post-war economic boom was ending. These are long-term factors that make growth harder. When an economy can't grow efficiently anymore, but you keep printing money, you get stagflation. Growth stagnates because the productive capacity isn't there. Prices rise because you're creating more money. Fourth, wage price spirals. Workers saw prices rising and demanded higher wages to keep up. Employers granted wage increases and passed the costs to consumers through higher prices. This created a feedback loop. Wages up, prices up, wages up, prices up, prices up. Breaking this spiral was difficult. It required accepting high unemployment to reduce workers' bargaining power. Brutal but effective. That's what Volcker did. Now let's connect this to the present because the parallels are striking. We're seeing the conditions for stagflation reassemble. First, supply shocks. COVID disrupted supply chains globally. Factories shut down. Shipping costs exploded. These disruptions haven't fully resolved. Then the Ukraine war disrupted energy and food supplies. Oil prices spiked. Natural gas in Europe hit record highs. Wheat and fertilizer became scarce. These are supply shocks similar to the 1970s oil crisis. They create inflation through rising costs, not rising demand. Second, massive monetary expansion. During COVID, central banks created trillions of dollars. The Fed's balance sheet went from 4 trillion to 9 trillion. Money supply exploded. This was intended to support the economy through lockdown, but it created enormous inflation pressure. When supply chains reopened and people started spending, too much money chased too few goods. Inflation surged. Third, structural economic problems. Productivity growth in developed economies has been slowing for decades. Real wages for most workers have been flat since the 1970s. The economy's ability to grow without creating inflation has diminished. We've exhausted easy growth. What's left is harder. Fourth, debt levels. Government debt is over $34 trillion. Corporate debt is over 10 trillion. Consumer debt is over 17 trillion. This debt burden makes growth difficult. Resources go to servicing debt rather than productive investment. And it constrains what central banks can do. If they raise rates too high, the debt becomes unserviceable. Defaults cascade. The system breaks. So they're trapped. They can't raise rates enough to fully control inflation without causing a debt crisis. But if they don't raise rates, inflation persists. This is a stagflation trap forming again. Let's talk about why stagflation is so dangerous, especially for empires. Inflation erodes purchasing power. Your wages buy less. Your savings lose value. This hurts everyone, but especially the poor and middle class. They spend most of their income on necessities. When food and energy prices rise, they're squeezed. The wealthy are more insulated. They own assets that often appreciate with inflation. Stagnation means no growth, no new jobs, no rising wages, no opportunity. Young people can't find work. Businesses can't expand. The economy feels stuck. This creates despair and anger. Put them together and you have inflation that makes everyone poorer, while stagnation makes it impossible to get ahead. It's a vice. People are losing ground and have no hope of recovering. This is politically destabilizing. The 1970s saw massive social unrest. Trust in government collapsed. The 1980 election was a landslide rejection of the incumbent. People were desperate for change. Stagflation makes people question the system. If the economy doesn't work, if playing by the rules doesn't lead to prosperity, why support the system? This is dangerous for empires because empires require legitimacy. People accept imperial rule if it delivers prosperity and stability. If it delivers poverty and chaos, legitimacy erodes. And empires in decline often face stagflation because they've exhausted growth potential but continue printing money to maintain the illusion of prosperity. Rome in the 3rd and 4th centuries had a version of stagflation. The economy wasn't growing, productivity was stagnant, but emperors kept debasing the currency to pay for the military and bureaucracy. Prices soared, the economy rotted, the empire became ungovernable. Britain in the 1970s had severe stagflation. The empire was already gone. The economy was declining. They printed money to fund social programs. Inflation hit 25%. Unemployment was high. Strikes were constant. It was called the Winter of Discontent. Britain's decline accelerated. Stagflation is a symptom of empirical exhaustion. Now let's talk about solutions because there aren't good ones. The 1970s solution was brutal monetary tightening. Volcker raised interest rates to nearly 20%. This caused a severe recession. Unemployment hit 11%. Businesses failed. People lost homes. But it worked. Inflation broke. The economy eventually recovered, but that solution worked because the underlying economy was still strong. Manufacturing existed, productivity could rebound, debt levels were manageable. Today, those conditions don't exist. Manufacturing has been offshored, productivity growth is slow, debt levels are astronomical. If the Fed raises rates to 20%, the government can't service its debt. Corporations default. The financial system collapses. So that option isn't available. They're constrained. The alternative is living with inflation, letting it run higher than they'd like, hoping supply chains fix themselves, hoping the economy adapts. This is what's happening now. The Fed raised rates to around 5%, not enough to fully control inflation, but as high as they dare go without breaking the debt market. They're hoping for a soft landing. Inflation comes down slowly without causing a recession. It's possible, but it requires everything to go right. Supply chains to normalize. No new shocks. Workers to accept real wage cuts as inflation outpaces nominal wage growth. It's threading a needle, and if it doesn't work, we're in stagflation. Persistent inflation, weak growth, high unemployment, no good solutions. Let's talk about what this means for you. If stagflation arrives, traditional strategies don't work. In normal inflation, you can invest in stocks or real estate. Asset prices rise with inflation. But in stagflation, the economy is weak. Stocks don't perform well. Unemployment is high, so real estate demand is weak. Bonds get destroyed by inflation. Cash loses value. There's no safe haven. Historically, the assets that do relatively well in stagflation are commodities, especially gold and inflation-protected securities. Commodities rise with inflation. Gold is a store of value when currency is depreciating, but nothing does great. The goal is to lose less. At an individual level, stagflation means you need to be defensive. Reduce debt. Inflation makes debt easier to repay, but stagnation makes income uncertain. If you lose your job, debt becomes a crisis. Build emergency savings. In uncertain times, liquidity is survival. Diversify income sources. If the traditional economy is weak, side hustles and multiple income streams provide resilience. Focus on essential skills. When times are hard, skills that provide necessities, food, repair, healthcare, are valuable. Luxury skills become less marketable. At a societal level, stagflation likely means increased government intervention, price controls, wage controls, rationing. Historically, governments facing stagflation tried to control prices by decree. It never works. It creates shortages, but they do it anyway because they don't have other options. Expect political instability. Stagflation makes people angry. They blame whoever's in power. Expect populist movements. Radical solutions. Social unrest. The 1970s had all of this. A repeat would too. Now let's talk about the empire angle, because stagflation is a sign that growth has exhausted itself. Empires grow through expansion. New territory, new resources, new markets, new productivity gains. But eventually, expansion ends. You've conquered everything worth conquering. You've exploited the easy resources. Productivity gains slow. Growth stops. But empires are built on the expectation of growth. Government budgets assume growth. Pension systems assume growth. Debt assumes growth. When growth stops, the system breaks. But empires can't admit growth is over, so they print money. Create the illusion of growth. inflate GDP with currency expansion. But printing money doesn't create real wealth, it just creates inflation. So you get stagnant real growth with rising nominal prices. Stagflation, this is where we are. The US empire has exhausted easy growth. Globalization is reversing. Productivity gains from technology are slowing. The workforce is aging. Resources are harder to extract. Growth is becoming difficult. But the system requires growth. So money is printed, debt expands, and we drift towards stagflation. The empire can't grow, but it won't accept that. So it inflates, and we all pay the price. This is the empire economy, where we decode the patterns of rise and decline. Stagflation is a decline pattern. It's what happens when empires try to maintain the illusion of prosperity through monetary expansion after real growth has stopped. It's a trap. It's painful. And the exits are limited. Understanding this doesn't give you a way out, but it lets you see clearly what's happening. In the 1970s, stagflation lasted over a decade. It was solved through brutal monetary policy and economic restructuring. Today's stagflation, if it fully arrives, may last longer. Because the tools that worked then won't work now. Debt is too high. The economy is too fragile. The empire is too exhausted. We're in the late stages. The patterns are unmistakable. Stagflation is coming. Maybe not this year. Maybe not next year. But the conditions are assembling. And when it arrives, it will reveal that the emperor has no clothes. That the prosperity was an illusion built on debt and money printing. That real growth ended long ago. And that we're now managing decline, not enjoying expansion. If you want to see these patterns as they unfold, subscribe to the Empire Economy, where you decode the mechanics of imperial rise and fall. Stagflation is one of the clearest markers of the fall, and it's already beginning.